Welcome to Truth, Money, and Freedom. Today is Tuesday, June 4th, 2019. Hey, gang, look at all this goodness. Look at this. The Dow up 512 points, the NASDAQ up 194, the S&P up 58. All an illusion. It is interesting, though, that the stock market went up. We had pretty bad news today. Um, I can go through all the news, and I will here, at least the pertinent parts of the news. But then I want to actually throw out a few other things on top of that. Look at the bond. The 10-year bond actually sold off today. So the yield went up, and oil is down just a bit. And precious metals actually went up today. Not by very much, but they did go up just a tick. So very interesting stuff. And of course, cryptocurrencies are taking a massive hit today. So I don't literally really pay a whole lot of attention to markets on a daily, thing. I do it, more of a monthly thing. But I think this might be a dead cat bounce. Once again, the fact that they're up is just amazing to me because we had a lot more bad news than we had good news. So let's look at a couple of things that may or may not have happened today. First, and by the way, I will link all these stories below, just like I always do. Today's buying panic, interesting that they used those words there, is being driven by the target, or I'm sorry, by the biggest short squeeze in 5 months. Okay, now for those of you who don't follow the stock market and don't know what a short squeeze is, let's pick a stock. Let's say Tesla. If a lot of people were shorting Tesla, and the banks knew this. The banks actually run, and the hedge funds and, all the trading firms and everything like that, like Charles Schwab and, Fidelity and all those gangs, know that there's a lot of shorts on the Tesla stock, and they know where those shorts are at. All they have to do is bid it up so everyone can make money off of the shorts. So what they do is they squeeze the short sellers out of their positions. So in other words, let's break it down. I want to bet that Tesla stock is going to go down. So I buy an option. I don't buy the stock. I don't care about the stock. I buy an option that says that the price of Tesla stock is going to go down. And then I have, variables associated with it by a certain date or by a certain amount, or it's just a plain short, just saying, hey, it's going to go down. And so suddenly, okay, and I buy that. I buy that option. I buy 25 options and they were 25 bucks a piece, whatever. So if lots and lots of people did this and then the stock suddenly goes up, like you see here in this chart, then those short sellers actually they get an option right away to with a margin call. So the trading agency they go through will literally call them up and say, hey, listen, Tesla stock has gone up, and we have to make payouts on people who are liquidating their call positions, the ones that said the price would go up. So where do they get that money from? They get it from the short sellers. So you have two options at that point. You can cough up some more cash to keep your short position because you still think the stock's going to go down, or you can literally just drop your position and lose your money. And that's what short selling is. That's what a short squeeze, that's what a short squeeze is. They squeeze all the short sellers out of the stock. So, and that's what I think happened. There is the most shorted stocks are the ones that literally went up. This is what we call, and by the way, I will link all this below so you can look into this and you can investigate it a little bit more. Take a look for it yourself. But it was the most shorted stocks are the ones that went up dramatically today when you look at today's numbers. So, yeah, my poor little dog here is thundering outside and she's just upset with that thunder. So she's got her head on my lap here. Okay, so at any rate, that is what this story is about. And this one's pretty plain and it's pretty easy to understand. Okay, now let's talk about the bad news. And that's global manufacturing contracts to a 7-year low. That's the PMI index. And this is very, very interesting to me because this is one of those indexes that has the ability to actually make the stock market go down. And basically, we got a 7-year low on the PMI index, the manufacturing index. And that normally sends the stock market downwards very quickly. And it is an easy, understandable way for, the talking heads on the mainstream media, money programs to say, yeah, it went down today because the PMI went down. So this one here kind of, and that's why I brought this one up. And there's others, and I can talk about others, but I'm not going to. I'm going to try and keep my video a little shorter today. So, at any rate, this was really bad news for the stock market. Really bad news for the stock market. And yet, these are the numbers we got today. So, let's go to the next story here. Dovish Powell slams yields and dollar as he opens the door for more unconventional measures. Now, unconventional is in quotes here because the unconventional measures are lowering interest rates and printing more money. That's not unconventional at all. That's what the Fed's been doing since 2008. So let's get into some of Powell's words here. Now, this is actually when he was speaking to the Chicago Fed. So this was actually, I believe this might have been yesterday, is when he did the speech. But basically, let me read a little bit. I don't want to read a lot of it, but sparking a renewed dovish knee-jerk reaction was Powell's flashing red headline that the Fed will act as appropriate to sustain the expansion. Okay, guys, this is a quote. Act as appropriate to sustain the expansion. I hope you're reading between the lines here. That means that he will print money and lower interest rates to keep the stock market up. So, for those of you who are listening to this podcast and have listened to us for a while or have just joined us, there are no free markets in the United States anymore. Don't let anyone tell you that free markets actually do exist. Certainly not in the stock market. There is no such thing. It is very controlled, and it's controlled by lots of very big major players. So he is admitting here they'll act as appropriate to sustain the expansion. Well, the expansion is mainly in the stock market, a little bit in housing, and the expansion, of course, in the bond market. So how are we going to act as appropriate to prevent a business cycle from completing? Well, there's the only two answers. Lower interest rates, print more money. So that's, he's telling you his plan here. So this may melt up. Under that speech here from Powell, you might expect the Dow Jones to actually go to 40,000, 50,000, 60,000 in the next 2-3 years, based on his speech. They're just going to print money and throw it in. Keep those numbers up. There's so many different reasons why they want to keep those numbers up, but there are two extremely important ones. Why is it important to keep the stock market up? Why can't we take a correction to fair market value on these stocks? Why do we keep pushing these PE ratios beyond the bounds of imagination? Anything that's reasonable anyway. PE ratios of 400 for Netflix? I mean, my God. Never thought I'd see that in my lifetime. It doesn't make sense. But it's very important. Here's the reasons why. Number one, a stock market that is going up makes people feel financially safe. They're more likely to take out debt and keep the system going. That's number one. Very important. Number two is capital gains tax is about 1/3 of all the tax that the federal government collects. So if the stock market's not going up and if people aren't trading, there's less capital gains tax. Those are the two principal reasons. There is a third reason, and which is, in the end, the bank owns everything anyway. And that's the end of the Keynesian cycle. It's about a 100-year cycle. We're at the tail end of it. And the banks will end up printing money out of nothing, buying up everything of value, stocks, bonds, real estate, mines, companies, whatever, anything of value. They just buy it up with money they print up because we believe it's real money. and they buy up all these assets, and when the money goes to zero, they still own the assets. So, okay, I digress. I need to get back on point here. We are closely monitoring the implications of these developments for the U.S. economic outlook. And, as always, we will act as appropriate to sustain the expansion. These are his words. These are his words. We will act as appropriate to sustain the expansion. It's a fake expansion. Okay, let me finish the sentence. With a strong labor market, lie. That's an absolute fib. And inflation near our symmetric 2% objective, another lie. Inflation's at 10%. Labor market, we have 21.3% unemployment. All these lies. For this entire speech, not one word of truth escaping Powell's mouth. This should make you guys angry. This should make you angry. So basically, let's continue here, and then I'll finish up my commentary. Powell said that with the economy growing, unemployment low, and inflation stable, it's time to rethink long-run strategies. Powell also hinted that both QE and ZIRP and perhaps NIRP are on deck. Okay, let me say what these are. QE is quantitative easing. It's a very fancy word for printing a feces load of cash and throwing it into the system. That's quantitative easing. ZIRP, that's zero interest rates. And perhaps NIRP, that's negative interest rates, are on deck. Okay, these are all extreme measures for an economy that is extremely sick, a very, very unhealthy economy. All to keep the dang stock market and bond markets up, to keep the illusion alive. And he just said it. I mean, literally, he just said it. This is not a thing where it's, oh, TC, you're speculating. That's what he means. No, no speculation necessary here. He literally said it. Quantitative easing, 0% interest rates, and perhaps negative interest rates, to literally keep this economy, this Frankenstein economy that isn't real, that's an illusion, alive. That's what Powell just said. Guys, this is not a joke. Everything will be linked down below, but he literally told you our economy is dead, and or it's near death, and we have to go to extreme measures again to keep it from, basically it's brain dead, and we need to keep the heart pumping, and this is what we're going to do to keep the heart pumping even though it's brain dead. This is really interesting. I'm going to show you again here inflation, because he brought up that 2% inflation lie again. This is Shadow Stats. I've done this before on some of my videos. You guys have seen this. And hey, my dog is jumping on my keyboard here. So at any rate, these are literally the stats for 1980 based alternate. In other words, using the same data that was used in 1980 to calculate inflation. John Williams says we're at 10%. But of course, the Federal Reserve says, no. We're at 2% because we're only counting clothing and electronics. Nothing else is included in inflation. Well, housing, cars, gasoline, groceries, tuition, all these things. Pharmaceuticals, hospitalization, all these things are no longer included in the CPI. They're gone. They're not included. And that's where the highest levels of inflation are. We're at 10%, says John, and I believe John. In fact, it may be going much, much higher here with these tariff wars we're about to go into. Okay. As I said, I didn't want to make this one very long, and I already have, but I think you guys are getting the point. We may not have a stock market crash going into the next recession. We may have what's called a melt-up. A melt-up is when the economy is horrible, but the stock market keeps going up, as evidenced by Venezuela. Venezuela is a perfect example of this. You just keep printing money, and then basically your stock market keeps going up because there's more money to put in it. But it doesn't explain the value of the dollar. All it tells you is how many dollars are in the market, the valuation of the stock. Okay, gang, as my dog is just going nuts here with this thunder, I'm going to let you guys go. Thank you very much for listening to Truth, Money, and Freedom. I